Mark Khuri joins me. You can learn what his team is up to by heading over to smkcap.com, smkcap.com. You can shoot a quick email to info@smkcap. Really appreciate your time here, Mark, as we talk about what you got going on and a few other things.
Yeah, Jack, thanks for having me on. I appreciate it.
So I told you we're going to start with your origins, and because you are a real estate superhero, so we got to find your origins, but we won't spend a ton of time on that. How did you find your way into real estate investing? It seems like more times than not, it's accidental.
Yeah, so my father, for example, is a big influence on me in my earlier years. He's been a real estate investor since the 1970s. I worked in corporate America for a number of years in financial analysis, Jack. I'll share with you a quick memory, but I was probably 23 in a cubicle. My cube mate sitting next to me looking at spreadsheets, and we're working together on a project. And he had a different spreadsheet up than what we were supposed to be working on. And sure enough, he was looking at a pro forma for a quadplex that he was in escrow to purchase. And so we dove into the numbers, the ROIs he was projecting were out of this world. I don't think he ended up purchasing the property, but I was pretty hooked at that point in analysis and looking at real estate deals.
That's interesting. My fella that I was working with in the cube next to me, we both got into real estate investing and the education of it at about the same time. And then one thing leads to another. You just start to feed off of each other. Next thing you know, you're trying to do it.
Right. Yeah. So that was a big part of the start. And I can share with you what we've done since then. That was, 22 years ago at this point.
Well, why don't we go into that? I was curious as to what are some of the biggest challenges you've experienced so far, and what did you do to overcome them?
Yeah, I mean, listen, very rarely is there not a challenge in this business. We've been through the recession of 2008 and 9, obviously COVID, and then hiking of the interest rates and inflation, increase in supply and multifamily specifically, and some self-storage. And so there's always challenges out there in the marketplace. That's essentially a lot of the risks that this industry has. And what do you do to work through them? I mean, first of all, you got to be confident. You got to have grit. You got to really have a strong spine because it's not an easy business to be in. If people are thinking about getting into the space, work with somebody that's been there before to start. That really helps. But you really need to understand that you're in the problem solving business. And so things arise, things come up. You have to really just be very detail oriented, have the right people around you that hopefully are more experienced and can help you work through some of the challenges that we face.
Well, you've been doing this now for almost 20 years.
Correct.
What's changed along the way?
Yeah. So a couple things I'll just mention, when we started out, it was myself and some of my brothers, my parents, right? Just pooling our own family capital. We were buying, this is during the recession and a little bit prior, Jack, pretty much all value add, heavy, distressed assets direct from the bank, all cash, foreclosures, short sales, REOs, and putting a lot of equity into them, time, effort, love, attention, money to improve them and either rent them or sell them. We pivoted from that business model in 2017, really focused on more diversification, providing our investors with access to other types of investments that we would gain through our relationships in the industry that we've created and cultivated over the last 15 to 20 years. And so that's a big part of what's shifted. We focus today more on diversification across asset classes, regions, various operating partners and sponsors, different strategies as well, fixed income, growth, hybrid of the two. So that's some of the evolution that we've experienced in the last 2 decades or so.
Sure. Yeah, that is kind of interesting because when you go to your website, your tagline says real estate diversified. So you really have a focus on that.
That has been a big part of our strategy and thesis really since the onset of our company when my father and I formed it formally in 2010. And the reason for that is to reduce risk, right? That's really the reality of diversification. It helps you continue to sleep well at night. If there's certain assets that might be underperforming in a fund or a portfolio, likely there's others that are performing well or outperforming that can offset that downside risk. And so we're constantly looking at risk mitigation. That's a big part of how we think. And diversification is top of mind for us every night.
So what are you diversifying into right now? What's your primary investment strategy?
Yeah. So a primary investment strategy today is, we are on our fourth iteration of our alternative fund. What we're investing into is a multitude of things. We have targeted several investments, the first being a triple net industrial sale leaseback portfolio. We're also combining that with a private real estate debt fund. So that's more of a fixed income investment. And then we've got 6 other investments in due diligence that could be combined all together into this type of diversified portfolio. So that's a quick snapshot. I'll pause here.
Yeah, well, I think you better go into that a little more detail.
Sure.
That some of your information on your site, it looks like it's kind of a blend of commercial property, but maybe I'm mistaken.
Yeah, we do focus on commercial real estate. We have been exclusively in this sector since 2017 when we pivoted away from single family houses. And so, just to clarify, when we say commercial, some people think office. That's not what we mean. We mean anything other than a single family house. So that includes self storage, it includes mobile home parks, it includes industrial, and it also includes multifamily apartments. Those are our 4 main asset classes that we target for investment, in addition to fixed income investments like private real estate debt funds. But essentially, Jack, it's trial and error, and also seeing the structure and composition of these assets, these investments, and how they're likely to perform across varying market cycles. Right. And so we got into mobile homes and self storage, for example, in 2012 because we had seen some positive trends during 2008. Some of the self storage REITs at the time were yielding a positive return while other REITs were down, 30+%. Next thing you know, you're going down a rabbit hole for years and start investing in them. Mobile home parks, similarly, we started investing right around the same time. You could see again during the recession, 2008 and 9, that a lot of mobile home parks had fared rather well. Demand stayed somewhat consistent. Rents didn't drop that much, right? And so compared to what was happening in other real estate asset classes, those two had fared quite well. And so we continue to invest in them today. We also enjoy investing in industrial, particularly in the triple net sale leaseback space. That is essentially, for those that may not be familiar, oftentimes it's a manufacturing business. They own industrial warehouses where they operate their business out of. It could be 1, it could be 10 different properties in multiple states, depending on the size of the company. A lot of times the business is being acquired by a private equity group, and they are not in the business of owning and operating real estate. And so what they oftentimes will look to do is to sell the warehousing, the industrial space, the buildings, the assets, the property, take that immediate source of revenue and inject it back into the business to operate and grow. And so what you have in that situation is where the seller becomes your tenant. And oftentimes you have 10 to 20-year triple net leases. And so long-term stable assets, they can provide positive income day one. And a lot of times you'll see rent escalations built in the leases, or you have predictable NOI growth. And then expenses, right, is a big part of inflation hedging. You got to look out for expenses. They've skyrocketed in the last several years with inflation. And this sector allows us to not worry about them because the tenant is responsible for all the rising and consistent expenses. That's taxes, insurance, maintenance, utilities, you name it. And so that's another sector we enjoy investing in.
No, well, it's always interesting, especially when you're talking about self-storage, for example. It's always shocking to me when you look at the statistics. A lot of storage is still owned by mom and pops and a few other things. So it makes a lot of sense.
Of mobile home park owners are mom and pops, right? They own 1, maybe 2 communities. And it allows you to source these deals that have not yet been fully squeezed, if you want to call it that, from an NOI growth standpoint. A lot of them are mismanaged. They're not looking out for the bottom line. They just manage to occupancy. They haven't raised rents to market in years, and maybe they're not billing back utilities. And they haven't put any capital back into the communities to make them look much nicer, more curb appeal. And so there's opportunities there with, like you mentioned, these mom and pop asset classes where you can acquire them at a rather nice, attractive basis and implement a business plan to grow the value.
With all of that, what is your plans for SMK here over the next number of years?
Yeah, I mean, we are consistently doing what we've been doing for the last 7, 8 years now, Jack, which is investing in these sectors that we mentioned. We're doing it in a few different forms. We just opened our fourth alternative fund, which combines them all together so people can diversify across all of this with one investment. And we're also doing some one-off deals here and there as well. We like funds, and we also like a direct investment where we're going to go invest in just that one property on 123 Main Street, for example. So over the next 5 years or so, our plan is to continue and to grow these investments that we focus heavily on. We're not planning to pivot too much. We'll see what the market gives us. We're very much data focused and data driven and constantly tracking trends to ensure that we are getting ahead of certain tailwinds and hopefully avoiding headwinds.
Well, what trends are you seeing right now?
You want positive or negative first?
Let's start with the negative so that we can end on a positive note.
I like either. So some of these will be familiar to folks, but over the last, call it a couple of years from 2022 to 2024, this industry that we are in has seen a pretty significant market correction, right? And so think about asset pricing. They've come down 20% on average, give or take. A lot of that has been due to rapid inflation post-COVID, with the Fed, of course, stepping in and raising interest rates at the fastest pace in 40 years. That slowed down transactional volume pretty significantly, which then oftentimes, in this case as well, reduces asset pricing. Cap rates have gone up, and so we're not completely out of the weeds yet. We'll see where interest rates go. They still remain somewhat elevated. If you look back historically in the last 5 years, they're quite elevated. But if you go back 40, 50 years, they're actually right about par. And so it depends how far back you're looking. The market's still correcting, but there are a lot of positive indicators that point us to believe that the worst is behind us. And we'll get into those in a second, but there are a few other headwinds or concerns. I think that there's just a lot of confusion out there about tariffs and about interest rates and where they might go or they might not go. And so that gives some buyers and sellers, of course, pause, and investors pause. Is the economy going to go into a recession? Nobody knows the answer to these questions. You can just look at trends and data and try and extrapolate a thesis out. And so we try and remain really cautious when there's, I would say, heightened uncertainty. But before we get to the positives, I'll mention, at the onset of COVID, we stopped investing entirely because there was, for 8 months, we didn't do anything, Jack. We did not invest in any new deals because there was too much uncertainty for us to get comfortable with, right? You tell everybody to stay at home and stop working. That to me is a recipe for a Great Depression. Obviously that didn't happen. There was a lot of mailbox money that everybody got. And so we avoided that catastrophe. We started investing in September 2020 again. Today, we don't think that that is the case. We don't believe that now is a time to be sitting on the sidelines and hoarding cash. There are actually some really attractive opportunities. The old adage, when there's blood in the streets, go out there and start looking for deals. And so that's essentially where we are at this point. As far as positive trends, again, we've seen real estate pricing drop about 20% on average in these sectors that we're in. That has since turned and starting to increase again for the last several quarters. Cap rates look to have plateaued after increasing for the last couple of years. You also see relatively stable interest rates. Obviously, the Fed started cutting rates in 2024. We'll see what happens this year. But there's a little bit less uncertainty as to what the borrowing cost on these assets is going to be than there was last year, and especially in 2023. Mm-hmm. Other positive trends I briefly mentioned, but we're already seeing an uptick in transactional volume, and that's a big one that we look at pretty regularly because as more buyers and sellers transact, there's more competition, there's more demand in the marketplace. Again, you tend to see pricing going up. And so we see all of those trends happening on a macro scale. And then if you need me to get into some specifics on certain real estate sectors, let me know, but I think that's a pretty good spot at this point.
Well, before we dive into the weeds on that, let's remind everybody, head over to smkcap.com, smkcap.com. That's going to be a clickable link in the show notes. If you found some value in what we're talking about so far, do us a quick favor, share this episode with one of your investor friends. So I would actually like to focus a little bit, because you've seen from everything from single family homes to what you're doing here today. Can you touch a little bit on some of the top risks you're seeing some other investors may be taking right now that they possibly should be second guessing?
Yeah, I would say, I mean, there's a lot of speculation investing. It's when you're investing with the hope that the value will increase in the future based on things that are out of your control. We tend to stay away from that. Almost everything we invest in, there's a concrete business plan that needs to be executed at the property after we acquire it so that we can be in some control of the future value of the asset. Watch out for speculative investments. I think that's a risk that we tend to not take. Another one I would say, especially today, but you've just got a lot of different people searching for yield, and watch out for rosy projections, right? Financial projections. Easy to financially engineer returns. And if you don't know how to look out for that, then you need to be talking to somebody that does. And so you could take a pro forma and adjust certain assumptions in 5 minutes. You can make the returns look much better than they probably really will be. And so that's a careful path you have to take in due diligence and underwriting. The last one somewhat coincides with due diligence and underwriting, but positive leverage. And what we mean by that is if you look at the going in cap rate of a deal versus the interest rate that they're borrowing the debt on, you want to see a healthy spread there where the interest rate is lower than the going in cap rate. So that's a big part of what we focus on today. 100 to 200 basis points of spread between the cap rate and the interest rate is a healthy place to start. You're usually going to see more positive cash flow in year one and a little bit less risk and more margin cash flow producing from these assets. And so that's hard to find today, especially in certain sectors because of the increase in interest rates that we've experienced over the last several years, but the deals are out there.
You mentioned before we hit record, you have another round coming up. Like, what are you acquiring and what's the plans there?
Yeah, so our focus right now is on our alternative fund four. Again, we're investing in triple net industrial sale leaseback properties. We've also targeted a private real estate debt fund. We are in due diligence on a mobile home park in Sarasota, Florida. We'll see what happens with that one. We are also looking at a tax exempt apartment community in Seattle, or just outside of Seattle, about 15 minutes. That is a niche asset class and sector that we've been focusing on for about 3 years in the apartment space, Jack. And so finding teams that are specialists in one thing and partnering with them is really where our focus is. Tax exempt apartments, self-definition, but they don't have to pay property taxes. They're exempt from doing so because you're providing affordable housing. And so you partner with the local municipality to essentially create affordable housing. And for that, we get a exemption from property tax for 99 years sometimes, and they're transferable to the next buyer. And so in those types of deals, we see nice positive leverage year one. The one deal we're looking at right now has 170 basis points of positive leverage year one. We'll see where that goes. Again, we're always in due diligence on deal, constantly looking at opportunities. Roughly 98% of the stuff we see, we don't invest in. It's just outside of our risk tolerance levels, just constantly trying to find what we call a sweet spot with deals that we perceive to have lower risk and still very attractive return. One last point, when we're underwriting and analyzing opportunities, we just have to walk away with conviction and be able to say, we feel very strongly that this deal can meet or beat the projected returns. And that's how we think about things.
A lot of people that listen to these shows, there's a chunk of them that they want to be active. They're likely starting in that single family arena, but there's a growing number that's looking to be more passive. and they're looking at syndications, what are some of those tips that you'd have them to make sure that a syndicator is a good fit?
Yeah, I think there's a few things you want to look at, right? So if you're looking at a sponsor, an operating partner, and going direct into one of their deals versus a fund like what we do, you want to look at their team and their track record and their background. How long have they been doing what they do? How well are they at it? How built out is their team? If one of them happens to pass, is that going to affect operations and performance, continuity of the business? We're typically investing with operating partners and sponsors that have over 500 million in assets under management. Many have over a billion plus in assets under management, built out teams, acquisitions teams, operations teams on the ground, back office teams, accounting, you name it. And so that just helps reduce risk for the most part, where you can, some team of members end up leaving or passing, you keep going, right? And so you've got to watch out for your capital. And then when you're doing that, looking at the team, you ask questions about their track record, their background. You want to see how they've reacted and responded in tough times. I don't think there's a group out there that has a perfect track record. If they do, maybe they're very lucky or they're very young and they haven't been through cycles. And so how did they respond? What did they do to help protect investors? Are they steering the ship with, investors' best interests in mind? And so with that, then you want to diversify and spread your capital across different deals, different operators, different sponsors, different locations, different strategies. Those are some of the ways to do it. Of course, there's deal analysis and underwriting. There's location analysis if you're investing in one community, one market. All of that is critical to trying to find the right deal.
Mm-hmm. Oh, I appreciate the insight. It's something that I'm sure people are asking themselves as they're trying to make that type of selection. So I really appreciate your time you've given us here so far, Mark. I do have a couple last minute questions here. One of them is, over the past 10 years, can you give me your biggest lesson that you've learned? And some, maybe you even had to make a pivot.
Yeah, I'm trying to think what the biggest lesson learned. There's a bunch there, Jack. So we've learned a lot. I mean, just like, groups that have been around for 10 plus years can tell you the same. I think a lot of it for us comes back to don't over leverage. Okay. And that means debt on an asset. And it also means spread your capital across multiple people and deals and opportunities. Going too heavy in one sector or one sponsor, it just increases risk. And so sometimes it's easy to do well for many years with a certain group, but also at the same time, it's hard to not do the next deal. And so don't overexpose yourself to any one thing. I think it's a pretty good lesson.
Can you tell me your biggest win over the past 10 years?
Yeah, I mean, from a straight ROI standpoint, there's win, of course, like you share. And then there's also more for relationships as well, which lead to future business and that kind of thing. But straight win from an ROI standpoint, we invested in a apartment community in Las Vegas in 2020. That was the one during COVID that we told you about earlier. It was a renovate all the units and sell in 3 years business plan. The market was at our tail, Jack. We were able to renovate 30% of the units. I think NOI grew maybe 40% or so, but cap rate also had compressed pretty significantly. And so we sold that in, I want to say 18 months. Investors got a 96% ROI from our deal in that one. Hard to beat that.
You mentioned other wins that are actually hard to measure, which is like relationships. Can you talk a little bit about that?
Yeah, I mean, there's investor relationships where you have to trust the people you're investing with. That can take a long time, Jack, right? And so sometimes you can reduce that time frame if it's a referral. And hey, I've been working with Mark for 6 years. Why don't you talk to him and see if he can help you guys out with what you're looking for? And so those kinds of wins is also what I'm referring to, other than just, ROI. In addition to that, there's a couple operating partners that we work with that, took 2 years for us to build a relationship and partner with them on their deals. And so now we we have that relationship built. And so they get off market deals. They share them with us one-on-one. Anyone else gets to see them and that kind of thing. And so those are our wins, in my opinion, too. It helps us understand the market, what kind of trends are happening on pricing, interest rates, borrowing costs, you name it. And so just being very active in the kind of the front lines is a big win for us.
Well, I really appreciate this time, Mark. Before we jump into the rapid fire questions and close out this episode, is there anything we should have tried to hit on here today?
I think you've asked some pretty good questions about the risk. That's always the first thing that comes to mind for us, and how to defer a bit of it or manage against it. I think the last thing maybe to think about is trying to understand growth. How quickly is a company growing, especially in the syndication space? Expanding too rapidly can create underperformance and mismanagement. And so try and think about that when analyzing an operating partner is a big part of the process that we look into too.
Just to remind everybody, smkcap.com, smkcap.com. That's going to be a clickable link in the show notes. You can always send an email to info@smkcap.com for more information. I'd really appreciate your time, Mark, but if you're ready, we'll dive into the rapid fire and close out this episode.
Let's do it.
What lie do real estate investors often tell themselves?
I think a lot of folks start now say it's easy and you can get rich quick. It's the opposite. It's hard and it takes a long time. So I would be cautious of that.
If you could go back in time and give your younger self a piece of advice, what would it be?
I would have started even earlier than I did, and I would have networked even sooner with more people than I did.
Do you have a book recommendation?
I would recommend What It Takes by Steven Schwartzman. That is the co-founder of Blackstone. He goes through his personal journey through life, summarizing the industry pretty well. And another one for you, if you want to get into technicalities of syndications and waterfalls and preferred equity structures and all of that, in the math side, is Investing in Real Estate Private Equity by Sean Cook.
And then finally, what single strategy or tool have you implemented that has had the biggest time-saving impact to you or your business?
I mean, we use AI every day for different types of analyses, the sourcing of data, also with writing clarity. It's a big part of saving time. And so that's a great tool. And then, a must-have for us, which most people use daily in our business, is Microsoft Excel. And so for those that aren't avid in Excel, take some classes and start learning it, because that is the main tool that everybody's using.
Yeah, and I don't know if you subscribe to Copilot, but it's pretty remarkable what Microsoft has done there to incorporate AI into that platform.
It's amazing. I use that, I use ChatGPT. They're all very phenomenal, these as to what they do.
Yeah.
Complexity. Thank you.
There you go. Well, I appreciate it, Mark. This was great. Again, it is smkcap.com. You can learn more information there, but really appreciate your time. I hope you'll consider coming back again sometime.
Thanks for having me, Jack. Appreciate it.